Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zach's Market Edge.
Welcome to Zach's Market Edge, the podcast about investing in your life. I'm your host, Tracy Reinick, and this week I'm joined by Zach's stock strategist, Jeremy Mullen, who is also the editor of Zach's Commodity Innovator portfolio. Perfect timing to talk about what else? Commodities. So commodities are among the hottest things out there, and they have been for the last year, but they're really picking up steam here in 2022 across a whole basket of commodities because of the Ukraine war. That's putting pressures on everything. We've got oil surging. We've just got people hoarding. I heard on the radio today they're hoarding sunflower oil now because that is a big product out of Ukraine. They are the largest producers. And a lot of the cooking oils were already tight on the market prior to the Ukraine war. And now it's going to get even tighter. So if you want some sunflower oil, apparently you need to get it right now, or you may not be able to, or you're going to have to pay. So we've got strange things going on various products like that. I was reading in Reuters here in March 2022 that you would think with the wheat soaring that this would be good for U.S. farmers, right? We're big wheat producers, even though Russia is the world's largest wheat exporter. Ukraine's also big on wheat and corn, but U.S., we're big on it too. And wheat prices are soaring. They went to new record highs above $12 a bushel. But according to Reuters, the spike was so quick in the U.S. that many of the farmers couldn't offload any wheat, like to the futures markets, to the buyers out there, the grain elevators, those guys. Nobody would buy it at the top because they were afraid they would lose money if they bought in at those super high prices. So that's kind of a wrinkle in there. You might think something was good for, say, the U.S. farmers, and then now it isn't. Then on top of that, you have fertilizer prices soaring. That's also impacting the farmers. Those are at 14-year highs. So some farmers are now cutting back ahead of spring planting season because they either can't afford the fertilizer prices or they can't get any. There is a shortage on some of the fertilizers. One of the big makers, again, Russia and Ukraine, both fertilizer producers. Some of the U.S. producers are trying to make up some of the slack, but that takes some time because it is actually mined. So it's not like you can just snap your fingers and have more fertilizer. So they're raising production, but can only do so much. So those prices are soaring. And then we just have the metals, copper at new highs. We have gold not doing as much as you might think with all this commodity inflation action going on. But Jeremy, I can't keep up. And even as an investor in some of these things, like if I'm a stock investor, I'm trying to buy like ETFs or some stocks that might benefit from everything going on. Those have surged a lot. And I'm wondering if, maybe it's too late to get in on this commodities trade, or if you see this going for, months ahead, and if we're just in the early innings, or what is going on out there?
Yeah. Hey, Tracy, thanks for having me. All great points you just made and everything that's happening out there in the commodity market. It is pretty crazy. And I don't think anybody should feel bad about trying to make sense of it all. I mean, it's hard for professionals to make sense of it. And that's why we see such just crazy moves. And I'll just go over some quick numbers for, what's happened over the last year. We got nat gas, 96%, crude, 72, coffee, 69, wheat, 66. And, they're from soybeans to corn to cotton to aluminum, they're all high numbers. The only thing really struggling is silver, still down 5%, but it's like all these commodity names have made such a push. And what we're getting right now is an external event in the news that's creating this extra pressure on the supply side of commodities, like you said, the war in Ukraine. And I kind of want to, you brought up a couple things that I can add to.
Yeah.
You brought up sunflower. And from my understanding, there's going to be a 35% drop in production of corn and sunflower out of Ukraine. And for the sunflower side, they are big exporters, also in wheat. Now, the winter wheat is already in the ground, so it's not as big as a problem right now, but to get it out of the ground could be a problem if the conflict is prolonged. So really, if this ends in 2 to 4 weeks, wheat prices should be relieved because they can get it out of the ground. Now, fuel is a big issue too, right? So any fuel to get that crop out of the ground is going to the armed forces of Ukraine, right? And so if this goes on for another 2-3 months, you're just going to be a lot of pressure of getting that crop, and it might be wasted. So there's just a lot of unknowns. We don't know. It's very hard to speculate what Putin's next move will be. If there can be a compromise, there's a lot of optimism that some kind of ceasefire or peace can be made, however that might pan out. But yeah, this is what is creating such pressure in the commodity markets. This external event that, we were along a lot of this stuff in Commodity Innovators, and they went up moving into this event. And we sold a lot before, and they doubled, tripled. It's just one of these things that nobody could see that coming. And now trying to get into these products that have moved so much, it's very, very difficult to make that call. Now, I think part of your question was is this kind of a longer term trend? Sure, it could be. I mean, there's more dynamic to this regarding inflation, right? So my recommendation would be to kind of wait for this event to pan out, because if there is peace made, a lot of these commodities are going to come in aggressively overnight, and then kind of see if this longer term trend is still sustaining. And this is when you want the exposure for a longer term idea into commodities.
So, I mean, even just taking a look at the fertilizer stocks, like Mosaic, for instance, ticker MOS. So that's at new highs. Year to date, it's up 66%. Over the last 2 years, I looked this up, it's up 581%. Now they mine the potash, so that's their key area, but they're only trading at 5 times their forward earnings because those earnings are soaring right now. But after a big run like this on something like a fertilizer that may, is going to be impacted by whatever happens in Ukraine, should I stay on the sidelines and wait? Because a stock like this, I think, will pull back if there's some kind of, peace agreement or, some kind of settlement over in Ukraine.
Yeah, for sure. It will. And, with that CF Industries, Agrium, those names, we were long, Nutrient is another, we were long all those kind of in and out earlier this year. And like I said, we got some nice profits, and this external event really got them going. And I would encourage investors, I know these things are hot, and like you said, there's some fundamental things showing up that make them look good. But just go back and look at 2007, 2008, and when corn, that's kind of came into trade in 2004-5. So I was kind of getting going with these hot names, Mosaic, CF, Potash. They were all, and Anderson's were all going bonkers. And there were some of the hottest stocks out there. And, when the grain markets pulled in, they did as well. And the market was dead for about a decade. And I want to reiterate, we have this external event, so they're getting going. If this event calms down, we will fall into this inflation kind of trend too. So I'm not saying they come all the way back down. There's still kind of like a nice thesis for these to belong these. But these levels after this run, I'm kind of looking for this macro pullback if this event can. I keep on saying that, but that's really what needs to happen. If this event goes away, we can kind of figure out where we're at.
What about with some of the metal companies, specifically copper? So I was taking a look at Freeport McMoran. FCX is the ticker, and that one is up year to date 18.5%. 2 years, almost 800% now. In 2 year time, copper's been red hot. It's a little different than the fertilizer, wheat, sunflower issue from Ukraine, because usually these metals kind of get hot when the global economy is hot. So is there further, momentum in these kinds of stocks like a Freeport? I looked at Southern Copper too. That's ticker SCCO. And that one is up 24% year to date and 2 years, 200%. What do you think about like these metal type of companies?
Yeah, the FCX, the Freeport really stings because we were along like $17, and we got a nice return on it. I think I sold high 20s, and you type it up today, it's at 50. So
Right.
yeah, copper has been trading in this $4 to $5 range over the last year or so, and it looks like it could break higher. The only thing that I'm hesitant with copper is like this whole, if commodities continue to go higher, there might be some demand destruction in all these areas. And China really kind of scares me if their growth is slowing. A lot of that demand comes from them. So
Sure.
you could see them pull back because of that. However, if it does stay just in its range, Freeport and Southern Copper and stocks that deal in copper are going to do pretty well. It's just you don't want to see the copper price collapse, obviously. So,
Right.
The difference between Freeport and Southern Copper is that dividend. Southern Copper has a nice high dividend. So if you want to kind of sit in the trade and get paid while you wait for it to pan out, if your thesis is inflation is going to remain over the next 5 years, that's a good place to be. Freeport's a little more volatile, but yeah, they're both great stocks to be exposed to that copper trade.
Okay. I'm gonna have to take a look because
I would. This is if you follow the copper price, under 4, I wouldn't want to be in the trade anymore. Over 5, you're like, I mean, that's going to be a possible breakout. So that's
Okay.
kind of like it's trading in that big range. It's either going to break out, or base, and if it bases, that's a fine place to be in like a Southern Copper because you get that dividend.
What do you think about some of the big cap miners that are like, I consider them kind of be like big oil, but in the mining side, like they have multiple commodity exposure, like BHP Group, ticker BHP. I used to own this like 17 years ago, the last time commodities were hot, because they have copper, but they also have oil, coal, nickel. They do fertilizers. They're an iron ore. Like this is like one of the big guys that's in like everything. So it feels like, hey, I can just buy this one stock and I'm getting exposure to basically everything across the board.
Yeah, it's almost like owning a commodity ETF when you're in that guy, right?
What do you think about those?
So I just bought Rio Tinto and commodity emitters yesterday. And so, kind of the same idea. Big dividends in these guys. I mean, they're both about the same market cap. I think BHP is a little bigger. I think I saw an 8% dividend in BHP, and Rio is actually double-digit dividend. So,
Wow.
I mean, these things pay out nicely. They have low PEs, kind of what you mentioned earlier with some of those other stocks. And yeah, so if these commodity prices remain in consolidation phase and don't break down, these stocks will hold up and they'll be great places to sit tight.
Okay. Yeah, because both are up year to date. Rio is up 14% and BHP is up 17%.
No, but I'd like to add also though, these can get volatile as these commodity prices get pretty volatile, which they have been lately. So
right.
I mean, if you just look in Rio in just the month of March, spiked up to 84 on the invasion, right?
Yeah.
And back under 70, and then it kind of broke some moving averages and fell down. What was that, last week? And then we kind of rallied back above some technical areas, and that's why I got back in the trade. So now it's back at 78. So 84, 70, 78. That's pretty volatile month for a stock that has like, that big dividend, $100 million market cap. Those are big moves.
So should investors be waiting for that kind of move again, like to buy on weakness?
Yeah, I was just going to say that. Exactly.
Okay. That makes sense. Because I feel like there's a lot of Johnny come latelys in a lot of these trades because of the invasion. And then suddenly everyone's like, how can I play that? And they all were like diving in at the same time. But I feel like they're going to have weak hands and they're going to dive out.
Right. Well, people are trading them like they're tech stocks now. So They're not tech stocks, guys. So let's be sure to be a little more You just got to be smart with this. And I would encourage people to look at the moving averages if you want some stop losses on this. If you're just in it for a trade, really that's your clue as to when to get out, because you don't want to ride these down if the commodity prices start to break down for whatever reason. Let's say this the war ends in 2 weeks, and then we get a 50 basis point hike, from the Fed. Well, that's going to put a lot of pressure on commodity prices. So you just got to be careful. These ideas and these stocks can change overnight. So you just got to kind of be careful.
Okay, that's good advice. Now, let's talk about gold, because I know we talked about it another time you were on the podcast, but it seems to me that some of the situation has changed, but it really hasn't with gold. So the gold isn't doing anything. Why not? Why shouldn't this be the one that I would want to be in, and to buy the GLD, the actual ETF that, owns the gold? Why would I not want to be in that right now with inflation doing? I mean, we just had a huge PPI out of Germany, for instance, over 20%. So why is gold not the place?
Yeah, it's hard to explain. Gold's always been the inflation trade. It doesn't seem to be as much anymore. I don't know if the money just wants to flow into something like Bitcoin. If you look year over year, people say it's not, Bitcoin isn't, but year over year, Bitcoin went up a lot with inflation. And gold just didn't. Gold just went flat, just hung around the $1,800 level, even tried to break down to the $1,700 level. So recently it spiked up. But why did it spike up? It was fear. It wasn't necessarily inflation, right? We started trending higher a little bit, but we really didn't get going over the $2,000 level until the invasion happened. So that's a fear trade. So once again, I'm a little nervous on what gold does, and we need this external event gone to give us a clue of what gold really is here. And right now, if I just look at the chart looks great. We've pulled back from that spike and kind of consolidating. And we can get back going over that 2000 level. But once again, if the Fed raises 50 and we get a ceasefire, does the fear goes away and we have higher interest rates? Is that good for gold? I'm not sure about that. Now, for the miners, as long as gold can hang above 1900, those miners will still be a pretty good trade, especially over 19 and into 2000. I love the miners just because they're kind of printing money with gold at that price. So I think you mentioned GDX is the miner that you want to be in for that. It has like Newmont, Barrick Gold, and Franco Nevada in there.
Okay.
So that's got. We have both. I have GDX. We've had that for a while in Commodity Innovators. And then UGL, which is another ETF. It's just kind of a smaller leverage ETF instead of the GLD. Either one works. Probably for most investors, GLD is the best way to get into the gold. And then if you want to play like those miners, then GDX is where you want to be.
I did take a look at GDX because I was just curious after I saw, kind of the so-so performance of GLD, that GDX year to date is up 18%, but GLD is only up 5%. And even over 2 years, it's up 83%, and GLD is only up 28%. So clearly it's kind of disconnected.
Yeah, GDX is definitely, with the price of gold moving to these levels and close to 2000, the moves are going to be amplified higher. Yeah. So it is kind of like a leveraged way to play this. Okay. Now, maybe you don't want to necessarily take that risk, because if gold does come down, it's leveraged down, right? It's going to fall pretty quickly. And we've been in this trade on the downside too. When gold kind of moved below 1800, we owned the GDX and we were negative almost 10%. So I think we're in the double digits positive now. I'm not really sure where we're at, but it's just as volatile as any of these other ones.
Do you recommend someone buy like the GDX just to get the full exposure versus trying to figure out which, gold miner is the one to buy, like a Newmont or something? Is it just easier to buy the basket?
Yeah, that's what I would do, rather than try to figure out which one. I mean, Newmont's great. It's one of the biggest ones. Yeah. But if you have like Franco Nevada and some other ones that actually have silver exposure in the GDX too, so it's just a little more diversification within that. I don't think like these all trade together. There's not going to be that much beta separation from each other, except when you get to those really small ones that are in the GDXJ. But yeah, GDX is definitely the play where you can kind of just buy that ETF and not think about individual earnings reports. You're just counting on the price of gold staying here or higher.
Okay. What else do we need to know about commodities? Are there any other ones that are out there that it's a good thing to be looking at for investors, or have we covered most of the ones that are, the ones everybody's looking at here in 2022?
Yeah, so the most popular ones are the oil, the gold. This is what everybody looks at and talks about, right? It's our daily lives, natural gas as well, of course. But yeah, I mean, there's a bunch of stocks out there that reflect the price of other commodities. So a lot of these steel names have been really hot. Your Nucors, Steel Dynamics. We have in commodity uniters, we have CLF, Cleveland Cliffs, which has really done a good job of reinventing themselves and getting some solid exposure to steel, but not steel prices. Like that stock it dipped down severely after some earnings a couple months back, and has just been on a tear since. It looks really strong. Aluminum, with Alcoa, and then there's some that it's really hard to find exposure. So cotton, lumber, sugar, stuff like that. It's hard. There are ETFs out there, but I think they've already had the meat is no longer on the bone, if you know what I mean. They've had their moves.
Yeah.
Coffee as well. One of the best tickers out there, Joe. So they've really had their moves, and buying on pullbacks might work. But one thing I caution, what's crazy about commodities, they tend to go up really quickly and come back down when that supply dynamic is fixed. So if you just look over the last 2 years, we had this demand destruction that sent crude oil negative, and all these other commodities were just destroyed. It's right when we started Commodity Innovators, like COVID hit. I buy a bunch of stuff, COVID hit, and everything goes, tanks, and we have to get out at quick losses. And then, so that was a difficult time where you kind of had to figure out where we are, because if everything closed down, there's no demand. So what happened is all the supply built. So what do the producers do? They cut off that because they want to stop losing money. So when COVID kind of ends, which it ended like 5 times and started again, but when we're finally back, which we seem to be, all this demand comes back, and now we still have a supply side issue that hasn't fixed itself due to multiple reasons. Supply chain, still some COVID shutdowns here and there all over the globe. It just hasn't fixed itself. The oil producers, they are fine. OPEC, they are fine with prices up here. They don't want to hit the market. So what we have now is the supply side. Add in the Russian invasion and the external event, we have a serious supply side issue. So it's going to take some time for this to remedy itself. But when it does, you just got to be careful with commodities, because they can go down as fast as they go up, which we saw in 2020. and you kind of have to just be disciplined when you're in these things.
Okay, that's good advice. But it sounds like you're not against people buying into some of these stocks at this level.
No, like I say, so we might be in a long-term macro kind of situation where inflation is just going to sustain commodity prices. And until that kind of narrative is gone, where that doesn't look like it's a possibility, you can be in the commodity stocks for sure. The commodities itself, I don't know, because there's going to be a lot of volatility. But these stocks, like these oil names, they're just going to be cash cows, right? They're going to have free cash flow, and they're just going to print money. So it's kind of a nice place to be if these high commodity prices can sustain themselves. So I would say I like the stocks more than I like the commodity themselves at the current moment.
Okay, that's good advice. And that's good for our listeners, because I feel like they're more into the stocks than trying to trade any of those commodities or do anything.
I'd also point out, like, I do think that when it comes to the hedge fund space, they're probably underinvested in this area still. So there might be some support, on any kind of pullbacks just from people who have missed a trade and looking to get in on this trade, because they do see that kind of opportunity if commodity prices can sustain these higher prices.
Yes, I definitely think most of the big funds have not been in any commodities, even the ones that are more acceptable to buy these days, like the agriculture ones, that they're all underinvested. What do you think about a lot of these companies? They have great free cash flows right now. They're paying those big dividends, but they're also doing big share buybacks. Like some of them are huge share buybacks. Do you think that is going to put a floor under some of these stocks? Like, so if there is like a 5% pullback in some of them, I've noticed this with some of the oil stocks, we're not getting much more than like a 5% pullback. And maybe that has to do with just the sheer huge size of some of these buybacks.
Yeah, that could be some of it. I think that, the current volatility is more kind of headline driven.
Okay.
I'm not sure if they're entering, now it's kind of like, yeah, we got this program and, if we get a larger pullback, maybe that's when they get, but they have to do something with this money, right? They can either disperse it to the investors through the dividend, they can go out and buy and, expand and buy another company, or they can buy back their stock. So, if they raise their dividend, that's going to support the stock. If they buy back the stock, that will support the stock as well. Depending on the company and what they pay for it, that can you buy a company, sometimes the stock can go down because you get more debt usually. But it's all about that cash. It's all about the cash and where they're going to put it. And yeah, like you said, it could definitely support the stock on any kind of big drawdown.
Okay. Let me recap a lot of the tickers that we talked about today in case you're interested in checking out any of these commodity plays. So there was Mosaic on the fertilizer side, ticker MOS. We had Freeport and Southern Copper on the copper side and just metals. FCX is Freeport, Southern Copper is SCCO. Then if you want just like a big basket of tons of the different commodities, BHP Group, they're Australian actually, but they are cheap and paying that big dividend. BHP is the ticker. And then Jeremy talked about how he just added Rio Tinto, another one that's like BHP competitor. RIO is the ticker there. It's also cheap and paying a double-digit dividend right now. Then we talked about gold. Of course, you can buy the gold ETF if you just want to own the commodity. GLD is the ticker, but Jeremy likes the miners. So you can get those in the ETF with GDX. That's the bigger miners. And then there is the junior one too. That's GDXJ, which is the junior smaller miners. And then he mentioned Cleveland Cliffs. That's on steel side. CLF is the ticker there. And he also mentioned Joe, that good coffee ticker. I think we talked about that on our last podcast too.
Yeah.
It's so good. And then Alcoa on aluminum. What's Alcoa's ticker these days?
AA.
Just AA on that one. And I think that covers most of it. So if you're looking around for some commodities, it may not be too late to get in on this trade, especially on any weakness in these stocks. Keep them on your watch list, but they're all printing the cash for now. And we'll have an update as we go on throughout this year and see what's happening on the commodity side. So you don't want to miss a single episode of The Market Edge because we're bringing you all these hot topics and there's plenty. So be sure to subscribe or get us on Apple Podcasts. We're on SoundCloud, we're on Spotify and Amazon Music, and anywhere you can get podcasts, you can find us. But be sure to get us somewhere, and I'll see you again next week with some more stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.